Investing can be the smartest financial move you make. While you might earn a steady paycheck from working, investing can put your hard-earned money to work for you. A wisely crafted investment portfolio can help you build tremendous wealth over time that you can use for your retirement, to send your kids to college, or for any other financial goals you might have. However, while it's fairly common knowledge that investing is a good move, there's also the question of what you should invest in, which is an extremely important piece of the puzzle. With that in mind, let's take a closer look at some of the most popular investment vehicles. We'll discuss the pros and cons of each and examine whether they might fit into your ideal investment strategy. We'll also take a look at some of the things you probably shouldn't invest in. Welcome to this investment channel. Watch the full video to learn more about investing in wealth. Why stocks are good investments for almost everyone. Almost everyone should own stocks. That's because stocks have consistently proven to be the best way for the average person to build wealth over the long term. U.S. stocks have delivered better returns than bonds, savings accounts, precious metals, and most other investment types over the past 4 decades. Stocks have outperformed most investment classes over almost every 10-year period in the past century and have averaged annual returns of 9%-10% over long periods of time. To put returns like this into perspective, a $10,000 investment compounded at 10% for 30 years would grow to nearly $175,000. Why have U.S. stocks been such great investments? Because as a stockholder, you own a business. And as that business gets bigger and more profitable, and as the economy grows, you own a business that becomes more valuable. As legendary investor Warren Buffett puts it, investing in U.S. stocks is a bet on American business, and this has been an excellent bet for more than 2 centuries. Even across 3 of the most brutal stock market declines in history, the stock market has delivered better returns than gold or bonds. Consider the benchmark S&P 500 index, widely considered to be the best barometer of how large U.S. stocks are performing. 1. Gold. Yes, you can invest in gold and other commodities such as silver or crude oil. In fact, the practice of investing in gold goes way back, but that doesn't necessarily mean it's a great investment. Gold is a commodity, so its price is based on scarcity and fear, which can be impacted by political actions or environmental changes. If you are investing in gold, be aware that your moat is based on external factors, so the price can fluctuate a lot and quickly. The price tends to go up when scarcity and fear are abundant and down when gold is widely available. 2. Bank products and CDs. Bank products are investment types offered by banks that include savings accounts and money market accounts. Money market accounts are similar to savings accounts but typically earn higher interest rates in return for higher balance requirements. A CD, or certificate of deposit, is another type of bank product. When you purchase a CD, you agree to loan the bank an amount of money for a designated amount of time in order to earn a higher amount of interest on it than you would in a typical savings account. CDs are an extremely low-risk investment, but with low risk comes low reward. Most banks offer CDs at a return of less than 2% per year, which is not even enough to keep up with inflation. 3. Cryptocurrency. Cryptocurrencies are one of the newer types of investment. They are unregulated digital currencies bought and sold on cryptocurrency websites. Cryptocurrencies, such as Bitcoin or Dogecoin, have gained a lot of interest in recent years as investment vehicles due to their quick and dramatic growth. However, they remain an incredibly risky investment because of the many unknown factors associated with them. There is the possibility of government regulation and the possibility that cryptocurrency will never see widespread acceptance as a form of payment. Cryptocurrency currently has no intrinsic value and it could disappear as quickly as it came into existence. How to invest in Bitcoin. In the same way that you are able to exchange US dollars for any other currency such as yens or euros, you can also exchange your US dollars for cryptocurrencies. Though cryptocurrencies aren't technically part of the Forex market, the mechanics of investing in cryptocurrencies is very similar. The hope of many cryptocurrency investors is that the value of those cryptocurrencies goes up against the dollar, and they are relatively simple to buy online. Someone who invested in Bitcoin in 2013 and sold it today would certainly make some incredible profits. The problem is that there's no way to time the cryptocurrency market. 4. Bonds and securities. Bonds and securities are other types of low-risk investments. Bonds can be purchased from the U.S. government, state and city governments, or individual companies. Mortgage-backed securities are a type of bond that is typically issued by an agency of the U.S. government but can also be issued by a private firm. 5. U.S. savings bonds and corporate bonds. When you purchase any kind of bond, you are loaning money to the entity you purchase it from for a predetermined amount of time and interest. Bonds are considered safe and low risk because the only chance of not getting your money back is if the issuer defaults. U.S. saving bonds are bonds backed by the U.S. government, which makes them almost risk-free. Governments issue bonds to raise money for projects and operations, and the same is true for corporations that issue bonds. Corporate bonds are slightly riskier than government bonds because there's more risk of a corporation defaulting on the loan. Unlike when you invest in a corporation by purchasing its stock, purchasing a corporate bond does not give you any ownership in that company. An important note to remember is that a bond may only net you a 3% return on your money over multiple years. This means that when you take your money out of the bond, you'll actually have less buying power than when you put it in because the rate of growth didn't even keep up with the rate of inflation. 6. Mortgage-backed securities. When you purchase a mortgage-backed security, you are once again lending money to a bank or government institution, but your loan is backed by a pool of home and other real estate mortgages. Unlike other bonds, which pay the principal at the end of the bond term, mortgage-backed securities pay out interest and principal to investors monthly. 7. Investment funds. Investment funds are made up of a pool of money collected from multiple investors that are then invested into many different things including stocks, bonds, and other assets. The collection of investments typically tracks a market index. 8. Exchange-traded funds. Exchange-traded funds, or ETFs as they're commonly called, are similar to index funds in that they track a popular index and mirror its performance. Unlike index funds, though, ETFs are bought and sold on the stock market. Because ETFs are traded on the stock market, you have more control over what price you purchase them at and will pay fewer fees. Your reward is completely dependent on how well or how poorly the index you invest in performs. Subscribe to our channel to keep up with new content. Your support and feedback are much appreciated.